want to keep the theoretical discussion to the minimum as possible because, would like to spend more time doing examples in class. So we're going to cover these topics as per the course outline. And basically, it's a lot of this material would seem like review because I'm sure you would have covered some of these basic concepts in an earlier accounting class. Maybe some of the material might be new, but otherwise it's just going to seem like review. So corporate form of business organization, we know that corporations, companies are separate legal entities. And there can be different kinds of corporations. There can be public sector corporations, which are owned by the government. So they could be government units. For example, the city of Calgary is a government corporation, right? The municipal corporation. Some of you may have heard that expression, the municipal corporation of such and such place. I grew up in a city called Calcutta. The municipal, it was governed by the Calcutta Municipal Corporation, right? The city of Calgary doesn't have the word corporation in it, but it is a corporation, a government unit. Or you can also have government business enterprises. We call them crown corporations. So an example would be Canada Post. Um, that's a government business organization, a government business enterprise. And you can also have private sector corporations where the management is or the setup is done by private individuals and not the government per se. And even within that space, you can have not-for-profit organizations. And in the case of not-for-profit organizations or government um, public sector corporations, there is no concept of share ownership, right? There's no shareholders as such. But when we get to the for-profit entities, we'll find that there is share ownership. And depending on how widely dispersed the share ownership is, and whether shares can be freely bought and sold on a stock exchange, we can have private enterprises and public enterprises. Private companies um, typically have one or few owners, um, and they're not publicly listed, so their shares can't be bought openly on a stock exchange. Whereas public companies can have literally millions of shareholders in some cases, and their shares are fairly regularly traded on a stock exchange. The one in Canada, the largest one in Canada is the TSX, right, the Toronto Stock Exchange. So we're going to limit our discussion to the for-profit entities in this chapter. And when we look at what we mean by the term shareholders equity, there can be various types of equity accounts. So we can have contributed, which is also called paid-in capital. And paid-in capital can fall under either share capital or something called contributed surplus. Share capital could comprise of preferred shares or common shares. Preferred shares have preference over the common shareholders with regards to receiving dividends. And in the case the company is wound up, they get their amount invested first, as opposed to, so first of all, the company has to pay off its creditors, all the liabilities, and then whatever amounts left, the company must return the capital to the preferred shareholders, and then whatever is left is distributed amongst the common shareholders. Contributed surplus is another type of paid-in or contributed capital. Uh, it's also called additional paid-in capital, and it's used in certain very specific circumstances that we will learn more about later tonight. Then you can have earned capital, capital that is earned by the company, and retained earnings is one example of that. So retained earnings represents um, all the total net income from the time the company was set up to the current time. minus all the dividends that have been paid by the company. And there can be some occasional adjustments made to retained earnings. You know, we will look at some of them, some of those adjustments in this chapter later. There is also accumulated other comprehensive income. That is an IFRS only concept. ASPE does not have the concept of OCI, other comprehensive income. So accumulated OCI is something that you'll only find applicable to companies reporting under IFRS. And OCI, in case you've forgotten, refers to a bunch of unrealized gains and losses on very, very, very specific types of transactions. I will expand on that a little bit later in a later slide. You could come across non-controlling interest. Now, that would only be the case if you are looking at a consolidated statement of financial position. NCI is in play when you have a parent company that owns fewer than 100% of the outstanding common shares of a subsidiary. You will learn more about this in the advanced financial accounting class, the class that you take after you finish this course. So looking a little bit deeper, so preferred shares, they have preference rights, as I was alluding to. They have preference rights over whom? Over common shareholders. Now, with regards to what? Well, with regards to distribution of dividends. So preferred shareholders must receive their dividend before any dividend can be paid to common. So think of, if you can imagine the African savannas, you know, the lions get to eat their share first, and then whatever meat, whatever game is left over, you know, it can be shared by the hyenas. So I don't mean to say that common shareholders are like hyenas or that preferred shareholders are like lions, but that sort of captures what happens here. You know, the preferred shareholders will receive their dividend, and then whatever's left, you know, whatever's left, uh, common shareholders might get paid some dividend in case the board of directors decides, or the money might be retained in retained earnings. In case the company's ever liquidated, wound up, then as I was mentioning, the preferred shareholders get their capital returned to them before the common shareholders are paid a dime. Now, preferred shares can come with a whole bunch of features, additional features. Uh, Again, I suspect you've heard of these features in an earlier course. You've come across them in a prior course, most likely accounting 240 or 255, I think, the one that you folks take nowadays. Not 100% sure, but I'm going to go on a limb there. So preferred shares can be cumulative. If they are cumulative, what that means is that in case the company um, does not declare or pay a dividend in a given year, the preferred the entitlement of those preferred shareholders to that dividend, the unpaid dividend, we call that dividend in arrears, does not lapse. So at a later time, whenever the company does declare a dividend, it has to pay the all the previously unpaid dividends to those shareholders. So the dividend keeps on accumulating, right? In case it's not paid off, the right to receive the dividend keeps on accumulating. All right, so that's the cumulative feature. Preferred shares may be convertible. So we saw convertible bonds. You can also have convertible preferred shares. And what happens is, if you kind of think about it, the preferreds, so there may be some investors who like the idea of receiving a fixed amount of dividend for a certain number of years. They want to wait and watch how well the company is doing. And if at a later point in time they are, you know, fairly comfortable with how the company is performing, they might choose to convert their preferred shares into common shares. Because remember, the common shareholders are the residual claimants. So if the company is doing really, really well, the preferred shareholders typically only get the amount of dividend that they're entitled to and nothing more, typically. but the common shareholders are entitled to everything else that's left over. So for a company that's doing really well, the common shareholders benefit from the upside movement. So the preferred owners, in case those preferred shares were convertible, they might choose to convert their preferred shares into common shares at a later time. How many shares they will receive would typically be specified in the offer document when the preferred shares were originally issued, right? So typically a company might say, okay, so these are convertible preferreds. Each preferred share entitles the holder to receive 10 common shares, just out of, just at a random number, say 10 common shares if they choose to convert. So I hold a convertible preferred share, and I feel that the company's prospects are really good. I might exercise my right and convert one preferred share and receive 10 common shares from the company, right? So that's how it works. They can be callable or redeemable. Callable, redeemable basically means that the company can buy back those shares. Usually, if a company is buying back the preferred shares, the company may have to pay a little bit extra, and that's called a call premium, right? The companies might have to pay a little bit extra to buy back the preferreds, force the preferred shareholders to sell back the shares to the company. Retractable is when the shareholders themselves can ask the company to buy back. Okay, they're both callable, retractable. We're essentially talking about the possibility that the shares may be bought back or may have to be bought back by the issuing company. And then the last feature that you want to look at is participating. Recall I said mostly preferred shareholders are only entitled to a fixed amount of dividend, not if they are participating. Now, participating preferred shares, then the shareholders, the preferred shareholders, may be able to get an additional amount of dividend, uh, provided the common shareholders have been have received an appropriate amount of dividend. Like that can only happen if a company. So last year, for example, a lot of the timber companies, they had a bumper year. They had record profits, so they declared special dividends. It is possible that some of them may have also rewarded some of their preferred shareholders if those preferred shares. It is not very common for preferred shares to be participating, but think of it as a sweetener, right? If when the company is trying to raise money, they could at times add this provision. Oh, in case we have a really great year and we are able to pay, a huge amount of dividend back to the shareholders, it is possible that the preferred shareholders might get more than the regular entitlement. And just think of the possibilities, they can have combinations. Preferred shares could be cumulative and be convertible, right? So those kinds of combinations are all entirely possible. Common shares, not a whole lot to talk about. They have voting rights, and they're also residual claimants. So if you think about the accounting equation, assets equals liability plus equity, if a company is ever wound down, the company will sell off its assets, convert all the assets into cash, pay off its liability, and then whatever is left goes to the shareholders. But wait, within the shareholders, there could be preferred shareholders and there could be common shareholders. Well, guess what? The preferred shareholders are only going to get back the amount, the face value of the amount of capital that invested. Whatever is left over then is split up amongst the common shareholders. And again, going back to that African safari sort of imagery, there can be different types of games. So this could be like a huge, let's hope the lions did not hunt down an elephant, but man, I mean, if ever that were to happen, hyenas would have a real field day, right? They'll get a lot of meat. I don't want to offend the sensibilities of anybody here. So please, my apologies if you don't like that comparison, but that's sort of how common shares work. If the company does really well, the upside it belongs to the common shareholders. They are the ones that gain the most. But at the same point in time, they're the ones that are risking the most because should the company not do well, it is entirely possible that the common shareholders' equity might just be wiped. Contributed surplus represents additional paid-in capital, as I mentioned, and it's used to record very specific types of transactions. So one type of transaction that you might have been exposed to in an earlier course would be if a company was to buy back its shares, right? If the company buys back its shares for less than the average book value. Well, then, as per the requirements in Canada, the company has to debit the common shares. Let's say common shares were being purchased for the book value, credit cash for the amount of cash paid. And if the company was able to pay less cash to buy back the shares than their book value, the difference is credited to contributed surplus. It kind of represents a gain on the buyback. We don't use the term gain when we're dealing with shareholders, right? You will be seeing contributed surplus in play when we look at chapter 16, when we learn about stock options or stock appreciation rights, or even in the case of convertible securities. You might recall we did an example of convertible bonds, and you might recall seeing the term contributed surplus being used. Or even when the company was issuing bonds with warrants, I used contributed surplus. That's an equity account um, that sits outside of common shares. Sometimes shareholders might donate assets. It's a very rare instance, but if that were to happen, if a shareholder donates an asset and does not really receive anything back from the company, then the company needs to credit contributed. All right, share transactions. What kind of share transactions will we be seeing? Well, typically we'll be seeing issuance of shares, and the treatment is pretty similar if you are issuing common shares or preferred shares. If the shares are issued for cash, it's a simple entry. You want to debit cash and credit the common shares. If, on the other hand, the shares are issued for some non-cash consideration, like some other asset, then under IFRS, we are supposed to use the fair value of the consideration received. Now, if that is not reliably measured, then we will use the fair value of the shares issued. And the journal entry in that case would be you debit whatever the asset received is. It could be land, it could be equipment, whatever, and credit the common shares. Now, it doesn't happen very commonly, but it was a common practice, I would say about 20, 25 years ago, that shares could be common shares, especially were issued on a subscription basis. So rather than requiring, the investors to pay up the full value, the full amount of the issuance price of the common shares, the company might say, just to induce them to buy or subscribe to more shares than they otherwise could, it's like make a down payment, right? You make a down payment, like you're interested in buying a condo, just make a down payment now, and then you can pay the rest of the money in installments, kind of thing. That's what a subscription basis really is. And so you would, at the time the people subscribe, you want to debit cash, credit an account called common share subscribed, and the amount that the potential investors have not yet paid, you're going to debit an account called share subscription receivable. And then later on, when the money is collected, you'll debit cash and credit the share subscription receivable. And then, of course, the company would need to issue shares. So credit common shares at that time. and get rid of the common shares subscribed account. That common shares subscribed is sort of a ghost account that will be reported as part of shareholders' equity, but it really isn't either paid in capital or earned capital. We'll be looking at examples of these. Companies sometimes will buy back their shares. Now that could be uh, because the company believes the shares are trading at an unusually low value. And by buying back, the company could be able to provide some kind of support to its stock price. In the U.S., given that dividends are subject to taxation, regular rates of taxation, whereas capital gains are often taxed at a lower rate. Um, Investors prefer that companies should just buy back the shares because if the investor tenders the shares back, any profit they make, they would be they would have to pay tax on just the capital gain, which is sometimes tax advantageous as opposed to receiving a dividend, right? So there could be multiple other reasons why a company would buy back shares. But whenever the company does, the shares are supposed to be debited at their average book value. Now, that average book value needs to be calculated, and you'll credit cash for the actual amount of cash paid. Depending on whether the cash paid is more or less than the book value, back, we may have to credit contributed surplus if the cash paid happens to be less than the book value, or sometimes the company would pay more cash than the average book value, in which case you would first remove any contributed surplus that the company might have on its books. And if there isn't any, you want to debit retained earnings for any excess. And we look at examples there. Conversion of convertible securities. If that were to happen, you would debit whichever security is getting converted. So say it was bonds payable that we looked at in chapter 15, or it could be preferred shares as well. You debit that security. You will also debit any contributed surplus that has been used at the time of issuance, so debit that out. And then for the total amount, credit common shares. I couldn't really find an example for preferred shares in the textbook, so I'm kind of leaving that example for now. Maybe at a later date, I'll just write up a question and share with you. Retained earnings. Okay, so this should be restated. All right, so retained earnings, I'm sure most of us have an idea of how retained earnings is calculated. You start with the beginning retained earnings balance, add net income or subtract net loss, subtract any dividends declared by the company, you get ending retained earnings. What I'm adding here is what might happen if the company either um, finds out a prior period error that needs to be adjusted for, or if a company was to make a voluntary change in an accounting policy, right? In both cases, the change has to be made retrospectively, and the beginning retained earnings number needs to be restated. So we get the restated beginning retained earnings and then move on with net income, dividends, and so on. These changes we will talk about later. Probably the last chapter for this course is the accounting changes chapter. So we will look at examples of that there. So this was just for your information that in case there is a change in accounting policy that the company made voluntarily, or if it came across a prior period error, then those two items have to be adjusted against the beginning retained earnings balance, and the adjustment needs to be made net of income tax. Is it going okay so far? Any questions at this point?
Not for me.
Okay, hearing none, moving on. All right, cash dividends. Now, keep in mind that dividends are paid out or declared out of retained earnings. So assuming the company has a positive retained earnings balance, the company can declare cash dividends, provided it also has enough cash left over after paying the dividends to take care of its short-term obligations. So cash dividends, they do reduce the retained earnings balance. And there are three key dates that we need to be aware of: the date of declaration, the date of record, and the date of payment. And I believe you have seen dividends in an earlier course. So just a reminder, the date the company declares the dividends, you debit dividends and credit a dividends payable account, or you could debit retained earnings, right? Either case is okay. The date of record, it happens to be a few weeks after the dividends have been declared, and the date of record is essentially the cutoff date to prepare a list of individuals who will receive the dividend. Um, After the date of record, basically on the date of record, whoever was the shareholder on the company's roster will receive the dividend. And then the date of payment tends to be usually a couple of weeks after the date of record. We record journal entries on the date of declaration and the date of payment. There is no journal entry recorded on the date of. Now, for private companies, these three dates can all just fall into one, right? They could all be collapsed single date, because for a private company, the share ownership doesn't change, that regularly. So we know who all the shareholders are, and as long as the board of directors meet and they approve of the dividends could be deemed to have been declared and paid on the same date. The actual checks might be sent out later, but the declaration and payment is often deemed to have a for private company. Public companies, because shares change hands a lot, you need to figure out who should be receiving the dividend. That's why you have that date of record in between. You can have other types of dividends. So stock dividends are a common ploy to create this illusion that the shareholders are receiving something. Um, Stock dividends don't really affect the assets because you're not paying cash or anything, right? You're essentially issuing more common shares. So the practical effect is that retained earnings is reduced and common shares balance goes up. Other than that, really nothing happens as far as the company is concerned. Um, Shareholders don't like stock dividends because keep in mind dividends are subject to taxation. So the shareholders haven't received any cash, but they'll have to pay tax on the amount of the dividend. So it's not liked by shareholders. So it is kind of a rarity for companies to be using stock dividends. Dividends in kind, again, not a very common occurrence, but they have been known to have happened. Maybe I would say more likely used in a private company. Uh, so you don't have a lot of shareholders to start with, and maybe the company has like a 5-year-old Lexus that the company is going to buy a new car. So instead of sending the car back to the dealership, the company might say, you know what, we're just going to issue this car as a dividend in kind to one of our shareholders, and that could just be the big uber the company majority shareholder. And that can sometimes happen. In the past, there was an instance where um, I, I think it was DuPont Corp, which is a large chemical company in the US. They owned a lot of shares of GM. I think it was GM or GE. I'm forgetting exactly, but one of the G's, right? Either General Electric or General Motors. and the company, the directors decided that they needed to offload some of the shares, and instead of selling the shares, because if you sold the shares, and you owned, let's say, a few 100,000 shares of such company, you try to sell all of them at a same time, can have disastrous results on the market price of the shares. So instead, what the board did was, rather than selling the shares, the company distributed the shares as dividends in kind to their own shareholders, right? So imagine you were a shareholder of DuPont. Well, DuPont Corporation, rather than paying you cash, basically gave you a couple of shares of General Electric or something, right? Like, so you're getting dividend in kind. So that kind of thing has happened in the past historically. Doesn't happen very much to my knowledge nowadays. Liquidating dividends, well, that happens if the company is winding down. So it's a more of a return off capital rather than a return on capital, right? Dividends are usually seen by investors as a return on the capital that they have invested in the company. But if the company was kind of paying back the amount that the investors have invested, then that would be seen as a liquidating dividend. And these typically are issued out of contributed surplus instead of retained earnings. Then you have something called stock split, which isn't really a dividend. Um, the company could now, Apple, I would say it was a year and a half ago, that Apple did I think it was a 10-for-1 stock split or something like that. So previously, if you owned one share of Apple, after the stock split, you would have 10 shares of Apple. Now, of course, you're not going to become overnight a millionaire, because the value of the shares after the stock split would be 1/10. Right? So the idea there is to try to attract more investors, right? More people to invest in the shares. So make the shares appear to be more affordable. Um, like Amazon shares right now are probably what, 2,000 some dollars. Not a lot of people would be able to go and buy a ton of Amazon shares. But if Amazon was to do a 10-for-1 or a 20-for-1 stock split, then what would happen is each of Amazon's shares. So, if I own one Amazon share and the company did a 20-for-1 split, I would then have 20 shares. Each will be worth 1/20th, right? So from 2000, the value will go down to $100 each, but I'm going to have 20 such shares. So total value for my shares doesn't change right away. But if more people are able to now invest in those shares, buy the shares of Apple, or sorry, Amazon, then there will be more interest, right? So you would say there's more demand for the shares, and that could help um, just create an opportunity for the share price to go up even more. Reverse stock splits happen as well, and that can happen when a company, if it's listed on a US stock exchange, certainly some of the US stock exchanges require that the company's share not fall below a certain amount. Say it's $5, right? If the company's stock falls below $5 and stays below $5 for a time, the company might have to be delisted. So if you don't want to be delisted, right, removed from the list of trading stocks on that particular exchange, then what you could do is do a reverse stock split, where you could go the opposite way, right? For every 10 shares that you owned earlier, Mr. Shareholder, now you will only have one share, but that one share will be worth 10 times what the individual shares were worth earlier. Right? So those are ploys that companies would use. Overall, there's no change to the shareholders' equity. All that happens is that the number of shares outstanding goes up or goes down, depending on whether the company is engaged in a stock split or reverse stock split. Your textbook goes into some details about how do you distinguish whether it's a stock split or a stock dividend. There is no there is really no actual hard rule to determine that. But usually if it's a small change, like, if I was a shareholder and I owned one share, after the action taken by the company, if I own, let's say, 1.25 shares, right? So that would be typically be seen as a stock dividend. But if I used to own one share and now I would own three shares or stuff like that, well, then that would be seen as a stock. That's kind of on the esoteric side. You can read more details in the textbook. I'm not going to split hairs here in giving you any more um, pointers about determining whether a corporate action resulted in a stock dividend or a stock split. Um, Investors typically don't like reverse stock splits because that usually happens when a company's stock is already beaten down. And a company does a reverse stock split, and then there is a chance that there are certain types of investors or people that short sell. So short sellers, if a company does a reverse stock split, short sellers can then have an opportunity to keep on selling short those shares, and the overall shareholder value goes down. That has happened with certain cannabis companies. Aurora Cannabis is one example. They did a reverse stock split and they still got beaten down, right? They went for a 1-for-10 reverse stock split, trying to prop up the stock price, and they still got beaten down. There are some people that believe that the prospects were not so not very well liked either. Accumulated OCI, you got to keep in mind there is no such concept under ASPE. So it's only an IFRS concept, and it represents the cumulative change in equity arising from unrealized gains and losses. And these unrealized gains and losses are related to certain non-shareholder transactions. Now, if you have a transaction with shareholder, you can never record any gain or loss, right? The quote unquote gain is recorded as contributed surplus. Any loss resulting from a transaction with a shareholder is debited to retained earnings. All right. So AOCI is the accumulated other comprehensive income. And you got to keep in mind OCI, other comprehensive income, it all pertains to non-shareholder transactions. Okay. So you would have seen in the first intermediate course the revaluation model. But even a company does a revaluation of assets, any write-up of the asset value is credited to OCI, other comprehensive income. And then in the investments chapter, you would have learned about fair value through other comprehensive income investments. They could both be in bonds or in shares of other companies. Those two you've seen in Accounting 315. In this course, you're going to learn about the remeasurement gain or loss on pension plans. So we're going to learn about that in chapter 19. And then in your advanced financial accounting course, you will learn about cash flow hedges and the translation gain or loss on self-sustaining an operation, right? So again, nothing to worry. There will be one more example that you'll come across other comprehensive income in this class. NCI, you'll learn more about it in advanced financial accounting. All right, statement of changes in equity. This is required under IFRS. And this statement is prepared usually in a columnar form. So you prepare columns, separate columns for every single shareholder's equity account. So if the company has preferred shares, you're going to have a column for preferred shares. Common shares, you're going to have a column for common shares. Contributed surplus, every type of contributed surplus will have its own column. Retained earnings will have its own column. Accumulated OCI will have its columns. And if you're preparing a consolidated set of financial statements, then there will be a column for non-controlling interest as well. Keep in mind, we will be learning about NCI in the advanced finance. A totals column needs to be provided as well if you're making a statement of equity, and we will look at an example of one very soon. I have planned for 4 examples. I hope that's a realistic ask. I've been extending your time and attention in the previous 2 weeks, so I'm trying not to hold you back too long. I also am mindful that you have a quiz tomorrow. Just wanted to remind everyone that the quiz will be available at 6 o'clock in the morning, and it will be available until 10 o'clock at night. I got a couple of emails on Tuesday for some bizarre reason about, oh, I'm going to be late for the quiz due to traffic. Well, we didn't have any quiz on Tuesday place. So it is on Fridays, right? Quizzes are not written on class night. And secondly, you can write the quiz anytime from 6 o'clock in the morning until 10 o'clock at night. Of course, it's limited in time, right? So this quiz you'll only have 45 minutes. So once you start the quiz, that's your attempt, and you will have 45 minutes to attempt the questions. I think there's a total of 16 or 17 questions. I can't remember exactly, but roughly that number. So 45 minutes, roughly, you get about 2.5 minutes to attempt a question. Mostly they are theoretical questions. There are some that will have some calculations to be done, but hopefully they won't take too long. Thanks for alerting me that we are not supposed to have responders, the lockdown browser. So I'm going to remove that need. You will be able to look up the textbook, do whatever you want, right? At the end of the day, if you attempt the quiz, you're guaranteed to get 50%, right? 50% for attempting. So really, there should be no reason for not attempting, okay? I will not be able to award any deferrals for the quiz. So please, um, look, I mean, we're going to take the better 2 out of the 3 quizzes. The attempt gets you 50%, really, like, so it is basically encouragement to just study a bit and have a look at how well you've been able to understand the material so far. It's all multiple choice. It's not too long. Yes, I am putting you under a little bit of pressure because of the 45 minutes, so it has got to feel, it's got to feel like an exam. You attempt it, you'll get 50%. You score more than 80%, you'll get 100%. Anything in between is basically, is the mark that you end up with, right? So totally good luck for tomorrow. And are there any questions at this moment before I move on to the example? And Maria, you're very welcome, but I would encourage people to not think about just the 50%, because keep in mind, if you want to get to CPA, you need a minimum of 60%, right? A C minus is the minimum that's needed for CPA. So 50% kind of just, sometimes people get very anxious, they're having issues at home and with life, etc. And I can understand, right? There could be the one-off. And so that is why the 50% is like, okay, if you came in and attempted it, you're going to get 50%. So, if you had one bad day, it'll not derail your efforts, right? Put you, in a position where you have to start wondering, oh, should I retake the course, etc. But that being said, please understand that we still have to do well enough on the rest of the assessment pieces, right? So please kind of keep that in mind. And it's 45 minutes, so don't be too. So kind of try to work on, if you have some kind of a timer, like try to time so that on average you're not taking more than 2 minutes per question. Some of the questions you will take less time. For the calculation questions, you might need a little bit more. So if you do the math, if it's 2 minutes per question and you're doing, say, 17 questions, that's going to take you to 34, 35 minutes. Yeah. You have 45 minutes. So there will be some extra time, some comfort, but please make sure that you don't get bogged down by a particular question, because that can mean, oh, you're running out of time for the rest. The grades you will be able to see after the quiz is done. So you will not be able to see the grades right away, but yes, you will be able to know your actual grades for quizzes. And I will be keeping a separate worksheet. So the final quiz mark, I will be tabulating and posting it to D2L at a later date. But you will be able to see on D2L the raw marks that you scored, right? So the quiz was out of 20 points in total. The calculation questions count for 2 points, and the theoretical questions count for 1 point each. All righty. Let us start with the examples here. So the first one, as at December 31st, 2019, Cayenne Limited, a public company, had 40,000 common shares outstanding. During year 2020, oops, sorry, I should post a link here in the chat box in case someone doesn't have it handy there. So Cayenne had 40,000 common shares outstanding, and during 2020, they had the following transactions. They just given us 3 transactions here. So one thing I forgot to specify, it was there in the slides, is whenever a company incurs any kind of stock issuance costs, those stock issuance costs are capitalized. What we mean by that is we reduce the common shares, the face value of the common shares for the issuance cost. Okay, so in the first instance, the company issued 6,000 common shares at $29 a share, less $2,000 in costs related to the issuance of the share. So basically, the company is receiving cash. So the journal entry is going to be, for number 1, it's going to be debit cash, and you're issuing common shares. Now, the stock issuance costs, we're not going to debit anything separately for the stock issuance costs. All right. So how much cash is this company receiving? It's issuing 6,000 shares. Each share they're issuing for $29. So if I multiply 6,000 by 29, the company issued the 6,000 shares for $174,000. Now the company also paid $2,000 cash for the stock issuance costs. Now this $2,000 that the company paid for the stock issuance costs, we debit the common shares account for it. Now you could have combined the 2 entries and said, the company received 174 minus 2, 172,000. So debit cash 172,000, credit the common shares for 172,000. And that is totally acceptable. So you can either break it down into two entries. First, record the issuance for the $29 each, and then record the stock issuance costs by crediting the cash and debiting common shares. All right. Number 2, the company issued 3,750 common shares for land appraised at $130,000. So this is the appraisal value. Remember, the appraisal value may not always be equal to the fair value. All right. We have to look at what other proof we have, what other evidence we have. The closing price for the shares traded on the TSX was $32 per share on the date of issuance. Now, we're stuck with IFRS. Under IFRS says if you issue shares for any non-cash consideration, right? You issue shares for some other asset but cash, use the fair value of the asset received. All right. Now, here we don't have any other evidence, right? So the IFRS 2 says use the fair value of the asset received unless it cannot be measured reliably. So this is where we have to kind of go with, like, there's a leap of faith that we have to make that the appraisal was carried out, at the time the company is, purchased the land, and it was done by a competent, unrelated, right, arm's length third party, that kind of thing, right? So usually, if you have any experience with, getting a getting a second mortgage or getting a HELOC, home equity line of credit, often the bank will send a person to come in and appraise the property, right? They'll come in, take measurements, look at the condition the property is in, and they provide a value to the bank. And we might often provide the property tax valuation, and the bank may accept the property tax valuation, or the bank's appraiser might appraise the property for a higher amount or even a lower amount. So over here, if we assume that the $130,000 is a reliable estimate of the fair value, then this transaction needs to be recorded at the $130,000. I'm going to put in a proviso here, assuming that the appraised value is a reliable measure of the fair value of land. Well, in that case, what you would do is you want to debit land and credit the common shares for $130,000. Now, if the appraised value is considered unreliable, right? So, maybe the appraisal was done a while ago, and since then property prices have changed, etc. In that case, we want to use the fair value of the shares issued. ASPE says whichever is more reliable, go with that. So ASPE doesn't have a preference. Under ASPE, if you have something like this happen, ASPE says use whichever value is more reliable. IFRS gives us a preference, says use the fair value of the asset received. If and only if that amount is not a reliable measure, then you should go and use the fair value of the shares. All right. So if the appraised value is considered unreliable, in that case, you would still debit land and credit the common shares. But then in that case, what you would have done is taken the 3,750 common shares and multiplied it by $32 per share. That would have worked out to $100. Okay. All right, number 3, purchased and retired 500 of the company's shares at $28 per share. The repurchased shares have an average issue price per share of $30. So they've given us the average price here. We don't have to calculate the average price. That's nice. Okay, so using the information provided, once the company buys back its shares, assuming the company is incorporated under the CBCA, Canada Business Corporations Act, you need to right, you need to, what's the word, derecognize, right? You need to get rid of the common shares. You want to debit common shares. That has to be done at the average book value. So we're buying back 500 shares, and the book value of each share bought back is 30. So 500 times 30, you want to debit common shares $15,000. Now you want to credit cash for the actual amount of cash paid. Now, how much cash did the company pay? $28 a pop, right? So cash, 500 shares times $28. Well, that's going to be 14,000. So the company's bought back its shares for less than their book value. The $1,000 difference, do not credit a gain on repurchase of shares. I've seen people do this. That is not allowed. When the company deals with its own shareholders, because keep in mind, who did the company buy back these shares from? People that owned the shares and therefore were, by definition, shareholders. Companies cannot record gains and losses when they deal with shareholders. So don't credit a gain on repurchase of shares. That is wrong. Instead, you will need to use the account contributed surplus, reacquisition of common shares. Just using some shorthand there. Because keep in mind, contributed surplus, for every separate reason that you're recording contributed surplus, you have to keep track of each of those um, amounts separately. All right. So I just didn't leave it as contributed surplus. I need to remember that this contributed surplus arose due to the reacquisition of common. Now, suppose this company at a later date happens to buy back shares and pays more cash than the book value, average book value. Well, in that case, what you would do is for the missing debit, because you would be paying more in cash, you'll need a missing debit. For that missing debit, you're going to first use up this contributed surplus reacquisition account, and then if there's still a gap, you would debit retained earnings. All right. Hopefully that is not new, nothing new, that you've seen these discussions, these concepts in the past. Any question on this so far?
Not for me.
All good? All right. So another example then. Let's look at exercise 15.6. And we're looking at McNamara Limited's general ledger. Shows the following balances on December 31st, 2020. They had 25,000 preferred shares outstanding with a book value of $625,000. Common shares outstanding, 40,000 shares, book value of $3 million. And their retained earnings balance is $890,000. And the preferred shares were 1 year in arrears. So 1 year in arrears means that, so current year is 2020, the dividends for 2019 have not also been paid on preferred shares. So if you recall, when preferred shares, if they are in arrears, you got to look at whether the dividends, the preferred shares are cumulative or not. Because if they are cumulative, then they will need to be paid their dividends in arrears before any dividend can be paid um, to the common shareholders. But not only that, the preferred shares holders must also be paid their current year's dividend entitlement. So if the preferred dividends are 1 year in arrears already, So 1 year plus another year for 2020, the preferred shareholders will need to receive 2 years worth of dividends, and then any dividend can be paid to the common shareholders. Okay, so that's the meaning, but it depends whether they are cumulative or not. If the preferred shares are non-cumulative, then it doesn't matter that the preferred dividends are in arrears. You will only receive the current year's dividend. That's it, right? So having preferred shares that are non-cumulative is not a very advantageous thing for the preferred shareholders, at least. So we've been given some scenarios, and we've been asked to figure out, assuming that the directors decide to declare total dividends in the amount of $445,000, determine how much each class of shares should receive under each of the conditions that follow. So preferred shares are cumulative and fully participating. Preferred shares are non-cumulative and non-participating. The preferred shares are non-cumulative, but they are participating in distributions in excess of 10% dividend rate on the common shares. So just giving you various scenarios to do some math here. Total amount of dividend declared is 445. So really it's about, that's my pie, the size of the pizza or whatever. How are you going to carve it up so that we determine how much of dividends should go to the preferred holders and how much should be paid out to the common shareholders. Right? So that's basically the big logic here. All right, so starting with, I would say, let's start with B, right? B is the easier, right? So looking at B, the preferred shares are non-cumulative and non-participating, right? So if preferred shares are non-cumulative, right? They will only be paid the current year's dividend, right? So any dividend in arrears, you got to forget about it. And if they are non-participating, they will be only paid their dividend entitlement. Now, how much dividend are these preferred shareholders entitled to? Well, notice there's 25,000 shares, right? So 25,000 shares, 25,000 preferred shares, and each preferred share pays a dividend of $1.50. So 25,000 times $1.50, the yearly dividend entitlement for the preferred holders is $37,500. So in case the preferred shares are non-cumulative and non-participating, they're only going to receive $37,500 of dividend, right? So preferred common total, and your dividend is, since the company's deciding to declare a total dividend of $445,000, and the preferred holders are going to get 25,000 shares times $1.50, $37,500. The common shareholders are going to get the rest. So 407,500 is the amount of dividend that the common shareholders get. Make sense? Hopefully it does. Now, what if we were looking at A? The preferred shares are cumulative. So if the preferred shares are cumulative, they will be paid the dividends in arrears and the current year's dividend. So remember, the dividend was in arrears for 1 year. So 1 year dividends in arrears and current year's dividend. So $37,500 for each year. So last year's unpaid dividends, this year's dividend, 37.5, 37, right? So the preferred shareholders are going to get that. Let's get that down. And I should put current year's dividend. Okay. Now, because the preferreds are cumulative, they will get their dividends in arrears. 1 year dividend in arrears. That's 37,500. Yeah, 25,000 shares times 1.5. And then current year's dividend, the preferreds are going to get another 37.5. Now, if the preferreds were cumulative and non-participating, right? So I'm just going to make a play of it. So I'm just going to do A and A alt. So if the preferred shares are cumulative, but they are non-participating, right? So the alternative here is assuming the preferred shares are non-participating. They are cumulative, but they're not participating. Well, in that case, remember, the total amount of dividend that the company's directors have declared is 445,000. So the preferred shareholders will get 37.5, a total of $75,000. Now, since we're saying assume that the preferred shares are non-participating, whatever's left will be paid to the common share. Right? The preferred shares, the shareholders in that case will get $75,000 in dividend. And because the total dividend is 445,000, the common shareholders will receive the difference, 370,000. But in the case of scenario A, the preferred shares are, we're told, fully participating. So what does that mean? As the preferred shares are fully participating, right? Fully participating, it means that they will receive a pro rata share of the total dividend. Right? So let's call this A alt 2. Okay. So alt 2, what am I saying for alt 2? Assume the preferred shares are not cumulative. Right? So if I just say, okay, they are not cumulative, but they're fully participating. What does that mean? So what will happen in that case is you're going to go, okay, preferred, common, current year's dividend. We're going to look at the number of shares, right? So look at the number of shares outstanding, right? So total number of shares. So for the preferred, there is a total of 25,000 shares. And for the common, there is a total of 40,000 shares. No, hang on. So what is so that's not how we do it. We first calculate a dividend rate. And yeah, so not this. Insert. Okay. So what is the total number of shares? Preferred shares, the total number of shares outstanding is 25,000. And for the common, the total number of shares outstanding is 40,000. Now the dividend, right? The total dividend that is paid for each preferred share is $1.50, right? So yearly dividend is 37,500. Now, the book value of the dividends of the preferred shares rather is 625,000. So the preferred shareholders have invested $625,000 in the company, and they receive $37,500 of dividend each year, right? So I'm going to add a few more lines to kind of show on an actual example. You don't really need to worry that much, but I'm trying to kind of give you the background right here. So what is the book value of the preferred shares? As per the text, as per the question, it's $625,000. Now, by investing $625,000, the preferred shareholders get $37,500. So their dividend rate is 600. So $37,500 divided by 625,000. And that, if you calculate as a percentage, is 6%, right? So basically, for every dollar that the preferred shareholders have invested, right, they get a return, they get a rate of return of 6%. So if the preferred shares are fully participating, then what we need to do is make sure that the common shareholders first get a matching dividend, right? So they should also get a 6% dividend. The common shareholders should get a 6% dividend on the amount that they have invested. Now, how much is the amount that the common shareholders have invested? Well, if we look at it, there's 40,000 shares, but the total amount invested by the common shareholders is $3 million. So common shareholders' investment is $3 million. Now, if the common shareholders were to receive a matching dividend, match to the dividend rate for the preferred shareholders, then the amount of dividend that they should get, right, the common shareholders should receive, is 6% of 3 million. And that works out to $180,000. So you give the preferred shareholders their portion, 37,500, which is based on their investment of $625,000. And then you pay the common shareholders their entitlement, which is 6% of 3 million, or $180,000. So that will then end up accounting to $217,500 in this case, right? $217,500, which is basically on a total capital invested of $3,625,000. Now, I will show you a shortcut in a second, right? I'm just kind of making sure that making sure that you understand where these numbers came from, right? So this 217,500, where does that come from? Well, you first figured out, remember that preferred shareholders have preference over the common shareholders. So they get paid their dividend first, and their dividend entitlement is $37,500 in total. And the preferred share owners, they have contributed capital totaling $625,000 to this company. So they're getting a return of a rate of return, a dividend rate of 6% for every dollar invested. Likewise, the common shareholders, because they have contributed a total of $3 million in capital, if they were to receive this base dividend of 6%, they should receive a total of $180,000. Now that's going to take care of, that's going to account for $217,500. Now, the total current year's dividend is $445,000, right? $445,000. So how are we going to get to that? So there, the calculation is going to look like this. So you would say the base dividend, matching dividend, if you would, right? Sometimes I've seen companies, textbook authors use matching dividend. I'm going to go with base dividend if it's all right. So base dividend for the preferred holders is $37,500, and that for the commons is $180,000, and that's a total of $217,500. So out of $445,000, if I remove $217,500, then I still will have $227,500 remaining. And that I'm able to split between the preferred shareholders and the common shareholders. And that would be the participating dividend. Now, how am I going to decide how much of this 227,500 should be allocated to the preferreds and how much should be allocated to the common? And again, like, I might be tempted, let's just split it half and half, right? Give half to the preferreds, half to the common. That wouldn't quite be fair though, right? The preferred shareholders are shareholders, but they've only contributed $625,000 of total capital. The common shareholders have invested way more. So since they have a bigger stake in the company, maybe what we should do is prorate the dividend amount based on the respective proportions of capital invested, right? So what should be the participating dividend rate? So or just the pro rata, basically. Like I wouldn't call that the participating dividend rate here. Pro rata for participating dividend. Divide 625,000, the amount of capital invested by the preferred shareholders, by the total amount of the book value of preferred shares and common shares. So that works out to 17.24%. So out of whatever's left, 17.24% of the $227,000 will be paid as dividend to the preferred shareholders. And whatever is left obviously belongs to the common, right? So what will end up happening in this case is you're going to get a total of $76,724 of dividends paid to the preferred shareholders and $368,276 as the dividend paid to the common shareholders. If you add up these two numbers, you get $445,000. Now that's a really long and roundabout calculation. First, I want you folks to kind of just take a couple minutes to see if this makes sense, and then I'll show you a shortcut, okay? To see if this makes sense, first of all. And then if it does, I'll show you this. Makes sense, says Rachel. As does Ragan. All right. So the quick and easy way, right, is that because these preferred shareholders are participating fully, right, fully participating, all we need is to look at the book value, right, the book values of these shares. So for the preferred shares, the book value was 625,000. Common shares, the book value is 3 million. Now we're going to use their relative proportions to calculate how much of the dividend needs to be paid to them. So total current year's dividend is 445,000. Allocate to the preferred shareholders their book value, which is 625,000, divided by the total book value of the shares, which is 3,629,000. Multiply that with the total 445,000. You do that, you get 76,724. And whatever is left goes to the. Like I showed you all of this stuff just to kind of explain the logic behind what participating dividends mean. But the calculation, if the preferred shares are fully participating, is really ridiculously straightforward. You just gotta use the proportionate book value of the shares to determine how much of dividend would be paid. Okay, this is good. All right. Now, let us go and do part A in the way they're saying. The preferred shares are cumulative and they are fully participating. So now we are merging the two, right? We're merging the two. Preferred shares are cumulative and fully participating. Here, what we need to remember is out of this $445,000, we must first remove the 1-year dividend in arrears. Right, so we're paying a total of $445,000. Out of the 445,000, first remove the 1-year dividend in arrears. The 1-year dividend in arrears was 37,500. So remove that 37,500 from the total. We're down to 407,500. Now this 407,500 will be allocated between the preferreds and the common shareholders based on their relative book value. So I guess I could just insert that here. So current year's dividend that we're going to give to the preferreds is 625,000 divided by 3,625,000 times 407,500. That's $70,259 and whatever is left will be paid to the common shareholders. So the total dividend that these guys are going to get, preferreds are going to get 107,759, and the common shareholders are going to get 337,241. Yeah, so for the formula, if you want to see the formula, Rachel, I don't know if you're sharing the file. If you do, all you need to do is just click on the cell and you'll be able to see the formula in the top bar, right? So if I double click, this is what you'll be able to see. So what I'm doing is preferred shares, the total book value is 625,000. That out of the total book value of the shares, preferred and common combined, 625 out of 3,625,000. That's how much the preferred shareholders are entitled to when they are fully participating. And you multiply that with the total amount of the dividend that is distributable for the current year, and that gives you 70,259. And since the total current year's dividend is 407,500, like 37,500 was for the dividend in arrears on account of the preferred shares being cumulative, right? We had to first pay them the dividends in arrears and then consider the current year's dividend. The current year's dividend distributable was a total of 407,500. The preferreds are going to get their prorated share based on the book value of the amount they have invested. All right. And then looking at C, the preferred shares are non-cumulative and are participating in distributions in excess of a 10% dividend rate on the common shares. So this one, preferred shares are non-cumulative and are participating in distributions in excess of a 10% dividend rate on the common. That's like a lot of yada, 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 but really what it's about is, okay, because they are non-cumulative, right? Because they are non-cumulative, we have to first give them a base dividend. Now, the base dividend is for the preferred shares, it's 37,500. For the common shareholders will get a 10% dividend, right? 10%. So that's already taken care of a total of $337,500. Now our total dividend, remember, is 445,000. Now out of 445,000, if we've already paid out 337,500, what's left for the participating dividend is 107,500. Now, how are we going to split that 107,500? That's our participating dividend. Well, basically the same way as we learned before. Preferreds, 625,000 divided by 3,625,000 multiplied by the 107,500. You get $18,534. So total dividend that we're going to pay to the preferreds is $56,034. Whatever is left will be the extra dividend to the common shareholders. So total dividend that we paid to the common is 388,960. So what makes this different from part A? Well, number one, the preferred shares were cumulative versus non-cumulative. That's why we had to first take care of the dividends and arrears. So other than that, what we were saying is they will get paid the dividends of in the same proportions of their capital investment. So 407,500 got split based on their prospective book value. Here, we made a distinction. We said, no, they're not going to be fully participating. We're going to give the common shareholders a base dividend of 10%, right? So that's why we had to remove 10% of $3 million. That's the basic amount of dividend that we're going to pay to the common shareholders. And 37,500 is the basic dividend entitlement of the preferred shareholders. So that will eat up $337,500 in total. Since the company's board has decided to declare a total dividend of $445,000, we can see that there is a possibility of an extra $107,500 to be distributed amongst the preferred and the common shareholders. How will we distribute that? Well, that's got to be based on the relative book values. So we got these numbers. This, I would say, is a much simpler way of thinking about the math than what your textbook authors have tried to work. Like that textbook solution seems to be a bit of a mess to me. It's too convoluted. All good? All right, let's keep going. Let's take a look at exercise 1512. So 1512, what are we looking at here? Falcon Corp reported the following amounts in the shareholders equity section of its December 31st, 2019 balance sheet. They have 10,000 authorized preferred shares, 2,000 shares are issued. The total book value is 200,000. Each preferred share gets an $8 dividend. Common shares, typically unlimited numbers are authorized. 25,000 is issued for a total book value of $600,000 there. They do have contributed surplus for $55,000, which arose from net excess of proceeds over cost on a previous cancellation of common shares. So this 55,000 relates to reacquisition of common shares. Then they have a retained earnings balance of $250,000, and they have AOCI 75,000, giving us a total of $1,180,000 of total shareholder equity. During the year 2020, they had a bunch of transactions that affect shareholders' equity. So numbers 1 through 6, and we are asked to record journal entries for these transactions. So part A, going through the journal entries. Number 1, paid the annual 2019 $8 per share dividend on preferred shares and $3 per share dividend on common shares. These dividends had been declared on December 31st, 2019. So if the dividends had already been declared, the company must have recorded a dividend payable liability. So now we are just paying off that liability. So for the first one, you want to debit dividends payable, preferred, and dividends payable common, credit. The dividends payable for the preferreds, each preferred shareholder gets $8, and there's 2,000 shares, $16,000, and $3 per share for 25,000 common shares. That works out to $75,000. Total amount of cash paid is $91,000. Okay, number 2, purchase 3,700 of its own outstanding common shares for $35 per share and cancel them. Okay, you want to debit common shares. You want to credit cash. Now, the cash that this company is paying, 3,700 times 35. The company is going to pay $129,500. Now, if you look at the common shares account, $600,000 is the book value for 25,000 shares. So 600,000 divided by 25,000 the book value for each share is $24. So the common shares, 3,700 times 600,000 divided by 25,000. So that number is $88,800. Now we're overpaying, right? We're paying more. How much more? We're paying the excess that we have is 40,700, right? That's how much extra cash we are paying. So we need to debit something for $40,700. And because this is the excess cash that the company's paid relative to the book value of the common shares, our first target would be contributed surplus. So the company has $55,000 in its contributed surplus account. So that is more than enough to cover this piece. So debit contributed surplus. Reacquisition of common shares. $40,700. Right? Now, if our balance of contributed surplus was say 30,000, since we overpaid by 40,700, you will first debit the contributed surplus for $30,000, bringing its balance down to 0. And then for the excess 10,700, we would debit retained earnings. Okay. Number 3, issued 1,000 preferred shares at 105 per share at the beginning of the year. So debit cash, credit preferred shares. Should just type this out as well here. $8 is how we got the dividend there, and 25,000 times 3. All right. So what's my math here? Cash that I got is I've issued 1,000 shares at $105. So 1,000 times 5 is 105. Debit cash, credit preferred shares. Number 4, declared a 10% stock dividend on the outstanding common shares at their fair value when the shares were selling for $45 per share. So 10% stock dividend. So you want to debit dividends or retained earnings, whatever your preference is. So debit, I go with dividends, right? And they've just declared, because number 5 talks about issuing the stock dividend. So I'm just recording the declaration entry, debit the dividends. And since we don't actually pay anything for this dividend, right? The stock dividend doesn't affect the company's assets position. You're going to credit stock dividends distributable. And this is, in this case, common shares. So stock dividends distributable, common. Okay. So what is the number of shares that we have? We began with a total of 25,000 common shares issued at the start of the year. And then we bought back 3,700 common shares during the year before declaring. I'm assuming that these are transactions that kind of follow chronologically. So 25,000 minus 3,700, the number of shares has gone down. It's now 21,300 shares. We declared a stock dividend of 10%. Right? So the number of shares that the company will issue is 10% of 21,300, which is 2,130 shares. And the dollar value per share on the date of declaration is $45. So the amount of dividends that we record is $95,815. And number 5, we issued the stock dividend. So what you do there is debit the stock dividends distributable account and credit common shares, 95 each. Number 6, declared the annual 2020 $8 per share dividend on preferred shares and $2 per share dividend on common shares. These dividends are payable in the year 2021. Okay, so dividends, debit dividends. And let's first deal with the preferred. So credit dividends payable preferreds. Now we started the year with a total of 2,000 shares. Then we also issued 1,000 preferred shares at the beginning of the year. So 2,000 plus 1,000, we have a total of 3,000 preferred shares. And each preferred shareholder is entitled to $8. So that's going to work out to 3,000 times 8, $24,000. Now for the common, the dividends payable to the common shareholders. Okay, so here if we do a little bit of math, we started the year with 25,000. Then we bought back 3,700, and then we had issued a 10% stock dividend. So what you can do for that is, since the stock dividend, for every 100 shares that were outstanding before the stock dividend, after a 10% stock dividend, we'll have 110 shares. So keeping that in mind, you can do this, right? You can take 25,000 minus the 3,700 times 110% to get the number of shares, and then multiply that by the $3 per share dividend entitlement. So that's one way. Alternatively, what you can do is, you know that 25,000 minus 3,700, well, 25,000 minus 3,700 is 21,300. 10% of that is 2,130. So what you could do is just say 25,000 minus 3,700 plus 2,130. So those many shares times $3 per share. Either way, the number is going to work out to total of 70,000, 200 and no, sorry, $2 per share, not $3. $2 per share. $2 per share. That's going to work out to 46,860. Total amount of dividend declared, therefore, is $70,860. Okay, so that's part A of this question. Part B asks us to prepare a statement of changes in shareholders' equity. Assume 2020 net income is 450,000. Comprehensive income was 455,000. All right. So the name of this company is Falcon Corp. Statement of changes in equity, year ended December 31st. Okay, so this one can be a little bit messy because we're going to need a lot of columns. And IFRS asks that we not only report the number of shares, right? So we got to articulate the number of shares outstanding as well as what the dollar value is. So first of all, for the preferreds, number of shares and what the paid in capital is. And then likewise, for common shares, number of shares and what the paid in amount is. And then you're going to look at contributed surplus. Then you're going to have a column for retained earnings. And then finally, you're going to have a column for accumulated other comprehensive income, AOCI. And then finally, there should be a column for total. Right, so quite a bit. Now you get started with the beginning balance, right? So the balance on January 1st, because that's the beginning of the year. This company had, at the beginning of the year, 2,000 shares issued, and the dollar amount was 200,000. So 2,000 shares, $200,000 amount. All right. Common shares, the company had 25,000 shares issued, and the paid in capital was 600. And contributed surplus was 55,000, retained earnings was 250,000, accumulated other comprehensive income was 75,000. The total shareholders' equity, and you just need to make sure that you're only adding the dollar amounts, not the number of shares, was 1,180,000. Corresponds to what we have here. Now, then we have to go through what happened during the year, right? So, the net income that was earned during the year, right? That was only determined at the end of the year. So what I do is I would say, look at what the share transactions were. So what this company did is they bought back, right? Reacquired common shares, reacquisition of common shares. I'm using some shortcut here. Number of shares bought back, 3,700. And the dollar amount that those shares were equal to was $88,800. So from the common shares account, subtract, sorry, I should just link it. That'd be easier. So 88,800 would come out of common shares. And we also debited contributed surplus for 40,700. So when you debit a shareholder's equity account, it goes down. So reduce by 40,700. And the net effect is a reduction in total equity of 129,500. And that should make sense because we paid cash of 129,500. So assets went down 129,500. Liabilities are not involved here. So there should be a corresponding reduction in shareholders' equity. And that's what we're seeing happen. 129,500 is how much shareholders' equity went down by. Next, what we did is we issued preferred shares. So issuance of preferred shares. We issued 1,000 shares, and the amount we issued the 1,000 shares for was 105,000. So that should make the shareholders' equity go up by 105,000. That's basically what happened. Then we issued a stock dividend, right? So stock dividend, we issued a total of 2,130. So issuance of common shares. We basically issued 10% of 21,300. So that's a total of 2,130. The dollar value that we credited to common shares is 95,850. But that 95,850 is coming out of retained earnings eventually. When you close out the dividends account, it's going to reduce retained earnings. So reduce retained earnings, dividend, 95,850. Now, if you look at what happens to total shareholders' equity, see there's no change whatsoever. Retained earnings went down, common shares went up, right? So there was just a rejig in the components of shareholders' equity. All right, end of the year, the company has earned total comprehensive income, 455,000, out of which net income was 450,000. So net income I should this should work as well. Net income, you're going to add to retained earnings. So that's $450,000. Other comprehensive income, OCI. Now, other comprehensive income, the total comprehensive income was 455,000 given. Out of that, net income is 450,000, and OCI will be the difference between comprehensive income and net income. Remember that comprehensive income is always equal to net income plus or minus other comprehensive income. So because the total of the comprehensive income number was 455,000, and out of that net income is 450, the difference, positive 5,000, is recorded as other comprehensive income. And that gets added to accumulated OCI. All right. And last thing to take care is the cash dividends. And I should have mentioned issuance of common shares due to stock dividend. Maybe just stock dividend. That is probably a better descriptor. So we issued stock dividends, which resulted in 2,130 common shares being issued, and the dollar amount transferred from retained earnings into common shares account is 95,850. All right, now cash dividends. We have to report for the preferreds and the common. The dollar amount of dividends declared for preferreds is 24,000, and the dollar amount declared for the commons is 4686. And that's entirely coming out of retained earnings. All right, once this is done, then it's just a small matter of adding up vertically. So balance on December 31st, the end of the year, the company has a total of 3,000 preferred shares. The total book value is $305,000. Okay, for the common shares, the total number of shares outstanding, you add up vertically, is 23,430. The total amount in the common shares account is 607,050. For contributed surplus, the balance remaining is 14,300. Retained earnings, we have a final balance of 533,290. And accumulated OCI, we have a balance of $80,000. Now, if I add up the dollar amounts, I get 1,539,640, and that is basically what our total should be for the total column is, and that's it. So again, a fair bit of work, but nothing really that you would put under rocket science here. The textbook solution presents so what they do is they take care of the comprehensive income part first, and then look at the changes in the share capital. But I don't believe that's a strict requirement. You could also do it this way, and it would be totally fine. All right, so that was part B. Part C, prepare the December 31st, 2020 shareholders equity section. Well, I'm not going to do that. It's basically this information that we have, these ending balances that we have, presented in this format, right? So preferred shares, $8 dividend, 10,000 shares authorized, 3,000 shares issued, total dollar amount, 305,000. Common shares, unlimited authorized, to 23,430 shares issued, dollar amount 607. Right, so I guess you can handle that. I hope you're able to handle that. If not, look up the solution. I'll update the solution at my end. I'm just not gonna take up your valuable time to show you how to reproduce something that looks like this using the numbers from row 72, right? Hopefully that's not too inconveniencing. All right, then, plowing on to the last of the examples, problem 15.8. This kind of looks similar to the one that we did just now. So I guess we'll just focus on the journal entries, right? The shareholders equity section, I'll leave it to you guys to do. We're just going to do the journal entries for the 6 transactions that they have here. So just looking at the shareholders equity information that they've given, preferred shares, 8% $100 par value. What does that mean? 8% $100 par value. Each preferred share has a $100 par value, and each preferred share receives an 8% dividend. So 8% of $100 tells us $8 per share is the dividend rate. Okay, and we have 4,000 shares outstanding, right? 4,000 shares issued. So $8 times 4,000, we can calculate how much the preferred dividend would be. Common shares, $2 par value, 200,000 shares authorized, 80,000 shares issued. In Canada, it is very uncommon for common shares to have a par value. But over here, if they do have a par value, well, that's how much these common shares have been recorded at. $2 times 80,000, that's the carrying amount, right? 160,000. Now, they do have a common share subscribed account, right? So there's a common share subscribed, 10,000 shares, and using the par value of $2, that works out to 20,000. There is contributed surplus, both for preferred and common, $20,000 and $940,000 respectively. There's retained earnings, $780,000. They added up the numbers to get a total of $2,320,000. And then they have subtracted common share subscriptions receivable, $40,000. So this company follows what's called the par value method. In Canada, it's rare, but if they're using the par value method, over here we can see that the company has, recorded a common share subscribed account for $20,000. If I go back and reproduce the journal entries they would have recorded originally, they would have debited subscriptions receivable, $40,000, credited common shares subscribed, $20,000, and they must have received some cash as well. We don't know exactly how much was the cash received, so there would be some debit for cash. Now, obviously, that journal entry wouldn't balance out without the use of contributed surplus. So contributed surplus can also end up being used for a company that follows the par value method, right? So if the company records its common shares at par value, then we can end up with contributed surplus arising. So this company has a pretty large number of the contributed arising here. Now, what we're going to do is focus on journal entries, all right? So journal entries is the part that I'm interested in here. And they're telling us the contributed surplus accounts arose from amounts received in excess of the par value of the shares when issued. So equipment was purchased in exchange for 100 common shares. The shares' fair value on the exchange date was $12 per share. So equipment was purchased. This is non-cash, right? Under IFRS, if you issue common shares for anything other than cash, you got to use the fair value of the asset received. Here, we have no indication whatsoever of the fair value of the shares of the equipment received. So we would need to default to using the fair value of the shares issued, because that is more readily, reliably measured given the information available. Okay, so for number one, our journal entry is going to be debit equipment and credit cash. Now, the transaction will be recorded at the fair value of the shares issued. So each share has a fair value of $12. Multiply that by 100. 100 times 12 is $1,200. Now, the company's not received any cash, so why did I even credit cash? My bad. The company issued common shares, so credit common shares. Since this company is using the par value method, it's going to record each share at par value of $2, because that's what it has, right? Each common share has a par value of $2. So 100 shares times $2, that's $200. But our journal entry is completely out of whack here because we're missing $1,000. Now that $1,000 is going to be credited to contributed surplus common. Okay, so this example is of a rare situation, but if a company does have par value shares, that is what you would do. Any amount of any difference in the amount recorded for common shares, because the common shares will always be recorded at their par value. The transaction will be measured at either, so in this case, equipment. If we knew what the fair value of the equipment was, we would have used that. And if we don't know the fair value of the equipment, then we got to use the fair value of the shares issued. The fair value of the shares issued is 1,100. So difference between the par value of the shares and the fair value of the shares issued is recorded as a credit to contributed plus common. Okay. Second transaction, sold 1,000 common shares and 100 preferred shares for the lump sum price of 24,500. The common shares had a market price of $14 at the time of sale. So we need to allocate, right? This 24,500 is how much cash was received. So debit cash, $24,500, that's given. Now we need to credit common shares and we need to credit preferred shares. So common shares, we issued a total of 1,000 common shares, and that's going to be recorded at par value of $2. So 1,000 shares times $2. That's $2,000. The preferred shares, we're going to use the par value of the preferred shares, which is $100 each. So 100 preferred shares times $100. That's 10,000. Now, clearly you can see the total is nowhere close to 24,500. So what we need to do now is allocate an amount to contributed surplus common and contributed surplus preferred. Now, IFRS says whenever you have to do an allocation, try to use standalone fair values. If standalone fair values for both items in this case are not available, then first allocate the fair value of the item that we know, and whatever is left is allocated to the remainder. So contributed surplus common, we're told that the common shares had a market price of $14 at the time of sale, right? So $14, par value is 2. So we, at least we know that the market price would indicate fair value, right? Market price is fair value. So $14 is the fair value of the common shares. So just like we had done here, right? The common shares, 1,000, we're gonna say, okay, out of the 1,000, each share had a fair value of $14. We have recorded common shares at their par value of $2. So the extra $12, we're going to credit contributed surplus common. So $12,000, $12 extra for each common share times 1,000 common shares. We're going to credit to contributed surplus. And then whatever is left is allocated to the preferred. This is just a plug to make the journal entry balance. Out of 24,500, if we subtract $2,000 recorded to common shares, $10,000 recorded to preferred shares, and $12,000 recorded to contributed surplus common, what's left is credited to contributed. Okay. Number 3, sold 2,000 preferred shares for cash at $102 per share. This thing is kind of getting a bit repetitive, right? So debit cash. How many shares sold? 2,000 shares. So 2,000 times $102. That's a total of $204,000. Credit the preferred shares account 2,000 at the par value, which is 100. That's 200,000. We have a difference, $4,000, that we are going to credit to contributed surplus preferred. Okay, number 4, all of the subscribers paid their subscription prices into the firm. Remember, we had a common share subscription receivable, $40,000. So that receivables been collected. So credit common shares subscription receivable. It's no longer receivable because we have received cash. The credit cash, debit cash, and credit the common share subscription receivable, total of $40,000. And as a consequence of receiving the money, we must now issue common shares. So that's number 5. The common shares subscribed were issued. When the company issues the common shares subscribed, you're going to credit common shares and debit the common shares subscribed account, right? So debit common shares subscribed, $20,000. Now, the $20,000 represents 10,000 shares. We know the par value for each common share is $2. So $2 times 10,000 works out to $20,000. So that's all good. There is no contributed surplus involved in this journal entry. Finally, number 6, repurchased and retired 1,000 common shares at $15 per share. Okay, so repurchased and retired 1,000 common shares at $15 per share. So you're going to debit common shares. The total number of shares retired is 1,000. But remember, because we are using par value of $2, the amount that we're going to debit to the common shares account will be 1,000 shares times 2, so that's $2,000. The amount of cash paid, well, we bought back these shares at $15 per share, right? $15. Okay, so that's the amount of cash paid, 15,000. Now here, we will need to debit contributed surplus. Now, because par value is involved, we need to do a little bit of math here. So I'm going to have to make a T account for contributed surplus, right? Okay, so we would have begun with contributed surplus common. $780,000. That was the beginning balance, 780. Right? That was the begin balance. Now, I just post these journal entries. I credited contributed surplus common for 1,000. Just look at the number of common shares. So we started with a total of 80,000 common shares. That was our beginning number. After the first entry, we issued 100 common shares, right? We issued 100 common shares. So common shares, the number of common shares went up by 100 as a result. For the second journal entry, was there any contributed surplus involved? Yes, there was. $12,000, and that was 1,000 shares issued. So 1,000 shares issued, $12,000. Okay. Number three, there was contributed surplus, but it's preferred, so we're not affected by that. And then we don't have any other journal entry that involved contributed surplus common. So we can add up and say, okay, so total contributed surplus for 81,100 shares, the total contributed surplus in dollars is 793,000. We're buying back 1,000 shares, right? So how much is it? For each common share, 793,000, if I divide by 81,100, for each common share, there is contributed surplus of 9.77805, like it keeps on, right? There's a decimal number. The company has bought back 1,000, right? So for 1,000 common shares, the contributed surplus should be debited for $9,778, right? $9,778 is what you're going to debit to contributed surplus. But that's not enough, is it? 9,778 is, am I doing my math right? Oh, I forgot to take into account these 10,000 shares subscribed. So even though there's no change to the contributed surplus, I need to add 10,000 shares subscribed. So that works out to what, 91,100? The number isn't driving. What am I doing? Seem to be making a mistake. Wait a minute. Oh my goodness. Can you believe it? Contributed surplus, the beginning balance was 940,000, and I'm picking 780. Jesus, been there. No wonder you're. Okay, does this make sense here?
Yeah, the 780 retained earnings.
Yeah, that was retained earnings. Yeah, I was just not looking at the numbers right. And
Yeah,
maybe I should just remove this 10,000 and then show you, this other issued, right? 10,000 issued. So that is how we get to 91,100 shares. $953,000 divided by 91,100 gives us an average of 10.46103 for 1,000 shares, that's 10,461, right? So that's the amount that we're going to debit to the contributed surplus common, but we've paid cash of 15,000, still more than the total of what we have debited to the common shares and contributed surplus. And so the difference, $2,539, that excess payment we're going to debit to retained earnings. Now it ended up being quite an esoteric example. Like I'm not very, I won't worry too much about